there, Joel Seach, Principal Advisor, Apprise Hub Health Group, coming to you this Tuesday, the 8th of April at 11:40am as the timestamp, just to give you a quick update on the latest market movement and volatility that's been occurring the past month or two now, but really come to a head the past few days. We've purposely held off on giving an update and doing this video because we wanted to try to fully digest what's been happening, the tariffs and the significance of those tariffs and what they've looked like. So what we want to do today is go through a few slides with you, a few different charts to just explain what's been going on, and then as always, if you have any questions, any concerns, anything you would like to cover off, always welcome to shoot us an email or reach out to us. So firstly, what I wanted to start with was the slides on this page here, which cover off some of the latest information, which I found really helpful. We went to an economic update last Tuesday. This was before the tariffs were announced, but it just spoke about what the tariffs may rise to. And we're talking in terms of the tariffs is that they're potentially going to be broader and higher than they first were thought. And we're talking in terms of they're the largest tariff or shocks to trade in over a century, so at the highest level it could go to since World War II. We can see here the overall more even line since World War II, or the plateau of the tariffs, and then this sharp increase which could be higher again once it's all said and done. So it's just the shock that the markets experienced from the Trump regime and what they've brought on. So it's come out higher and broader than first thought, and it's been more significant. So I guess in terms of what that means to who's in the president's sights, so we can see here, this is the trade indifference or the trade balance in terms of a negative to the US. So we can see China, the EU, Mexico, Vietnam are on top of the list there. Below that is more of has there been a change since 2016 and a slight improvement to China-US trade imbalance, but overall China's probably copped the biggest tariff hit along with some of the other countries there as well. And then China have then retaliated as the second biggest economy in the world with their trade tariffs back on the US, and they're at a bit of a stalemate at the moment, and where that will go will be quite interesting. So really, the president's out to try to remove this trade imbalance to get those dollars back onto the US shore, and then he can then go about his campaign of lowering tax rates and company tax rates to start to stimulate the economy domestically there and stimulate manufacturing. But it's a really interesting time in terms of what's happening, and it won't all be said and done just yet. You can see Australia down there is one of the lowest trade imbalances or differences there, and we copped one of the smallest tariffs at 10%. But these are the imposed tariffs right now, so it's not all said and done. It's not, forget about it. It's going to be then, okay, we've put these tariffs in. It's up to you to come back to us to see how you want to negotiate and deal. So it won't be the last of it all, but it's really policy driven at the moment. So that's one of the huge topics and the huge underlying themes we've seen with all the research that we've had and all the information we've had. It's such a stimulated approach from a policy position in terms of why this is occurring. So realistically, the underlying markets are still quite strong. The fundamentals are still quite strong, but it's largely and purely due to the policy that's been imposed with these tariffs. I guess one of the other things that we wanted to touch on was the potential risk of recession and potential stagflation. So recession is 2 negative quarters consecutively of negative GDP or growth, gross domestic product. So that usually is a sign of lower unemployment, lower GDP, and then the other one was reduced investment and consumption. The other thing, the key word that you might hear thrown about is a word called stagflation, which is in economist language. Stagflation is at the same time it's a increasing of prices, so inflation of prices, and decreasing of consumption and GDP. So what stagflation comes from is, in this situation at the moment, which they're concerned about, is an increase with these tariffs on the cost of goods and a decrease in consumption and GDP at the same time. So that's the word stagflation that you may hear bandied about a little bit. So the risk of recession is quite real, and it's not only here; it's abroad as well. Multiple countries could see this occur. So that was some of the main interesting graphs that came up when we were going through this this economic update last week. So a more volatile world economy, geopolitical and climate-related disruptions more common, a less globalised world, long-term trend decline in inflation and interest rates is over, and high inflation, but not back to the 1970s where we saw high inflation back then, which was one of the charts that we saw on here as well. And excuse me while I flick to it just to sort of give you inflation. So we had the 1970s really high inflation, then we had 30 years of very low and moderate inflation. We had the peak once we opened up after COVID again. We started really pushing migration and returning to work, and then we've been trying to peg that back domestically over the past year and a half or so with larger interest rate rises. So I think from the economic update we sort of said, or they came to the conclusion that the low inflation, the low interest rates won't get back to maybe where they were, but they're not going to be back at the peak of where they were in the 70s. They'd be sort of hovering somewhere, they feel, around this line here. The other really interesting chart that, or the snippet that came up this morning, which I wanted to share as well with you, was the S&P 500, which is the Standard & Poor 500. It's a stock market index tracking the stock performance of the 500 leading companies listed on the stock exchange in America, and this is a 5-year period of time, so all the way back till April 2020, which is just around the time of the of COVID. So just a reminder, the S&P is still up 80% in the last 5 years. Remember, the stock market has consistently bounced back every single time, back from the dot-com boom in the 2000s, when it recovered back to 2007, once that was the tech bubble. And then we had the GFC, which occurred in 2008, where the Dow Jones lost 50% of the market, and then it was a bull run since then from 2009 to 2020. The pandemic, which was COVID, which we all remember because it was quite recent, so we got the recency bias there. It was the fastest crash ever, and it rebounded and hit record highs in the year end. Short-term losses only hurt when you make them permanent. And the 4 things you need to do in the stock market dip, and some of the 4 key themes that we saw, is refuse to panic. It never pays out. It never pays off. Number 2, if you're invested, stay invested. 3, keep investing if you are investing. The shares and the stocks are on sale at the moment because, again, a lot of this has occurred from pure policy, government intervention, and it can be adjusted over time, and we'll see that potentially unfold. It's probably going to be rocky for a few more months, several months yet to come, but it'll be a daily moving theme. This is an example of the Standard & Poor's graph over that period of 5 years that I was just talking about then, 2,800 index up to 5,500 with this recent drop, or 5,000 I should say. And then you can see the All Ordinaries today, which is the Australian share market. This is just today, the bounce back that it's occurred from yesterday's, where it dropped off. So keep investing. Stocks are on sale, and that's historically over a point in time. The stocks historically, you can see here from 1990 all the way through to 2025 what's occurred with the share market. So when you get dips like this, it potentially can provide opportunities to be well invested, well diversified. Diversification isn't the cure-all and the panacea to everything. It's not going to mitigate downturns, and we all experience those and the emotions of those. But to zoom out and gain perspective, just like these sort of slides demonstrate here with the graphs, it helps give you perspective, and wealth builds over decades, not just days. So I thought that was really pertinent to share with you all this morning as well. The last thing in terms of financial advice and the power of it is staying the course is never easy. That's why we're here to guide, and we're here to help clients get through the emotions, because investing in wealth is an emotional game. So helping clients read between the lines, help them be a sounding board, keep unemotional and make tough and strategic decisions to ensure that our clients keep on track to their goals. So clients have the goals and objectives, and we've got emotions attached to those. You can't have one without the other, but it's about reading between the lines and helping. Financial advice and giving guidance and accountability is just like having a good coach and having independent counsel. It's enabling us to make rational decisions in emotional and irrational times like we're seeing at the moment. Keeping an eye on the prize of that long-term goal, that long-term horizon, ensuring we're ticking off the goals as we go, but keeping an eye on what the real aim here is and the consequences of trying to avoid making irrational decisions. And then the likelihood of maximising the achievement of those goals while minimising mistakes along the way. So hopefully today that video went a bit longer than I was hoping, about 10 minutes, gave you good insight in terms of what's been happening in the world and the market. We'll continue to share these things with you as we go, and as always, please feel free to reach out to us if you have any questions. Feel free to flick us an email with any thoughts or concerns. We're always here to have a chat to you and help guide through this volatile period, and no doubt brighter days will come, but it will be rocky for a little while. But yeah, feel free to reach out as we go. Appreciate you listening and look forward to chatting to you soon. Thanks for that. Bye now.